Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our October monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we'll jump right into it. First of all, a congratulations and an announcement of Nola, who's been serving our amazing clients for now 13 years. We also look forward to seeing her and you at our forum next week, where we'll be unpacking all of these things. If you haven't already registered, let our office know and we'll see if we have space available. But we look forward to having over 100 in attendance to discuss all of these items in more detail. We also look forward, we haven't sent this announcement out yet, we will be soon. Our annual curbside event with tamales and treats on Saturday, December 6th from 10 to 12. We'll also be supporting a local food pantry. So we look forward to seeing many of you there and look for that announcement in the coming weeks. So the markets have been wild so far this year as we approach the last quarter of the year. A lot of this market could be traced as what happened between January 1st and April 8th, and then what's happened since. If we look at tech stocks as an example, tech stocks went down 24% from January 1 to April 8th, and since then have gone up 40%. Broader stock market, you'll see a similar before April 8th and then April 9th and beyond. So we've seen a significant rebound off of the April lows. And big picture, the economy looks in pretty good shape. We saw the most recent reading on GDP at just under 4. Now we are seeing jobs, and we'll talk about this in more detail in just a second, being a little bit weak and light. So we'll talk more about that, but the economy remains strong. But labor and jobs is a little soft at this point. Earnings so far this year, we'll wait and see for Q3, but overall have surprised to the upside. So the red indicates what was expected, and the yellow represents what actually happened. So an almost 2x to the upside in Q1, and an almost 3x to the upside in Q2. And the expected earnings in Q3 are up 7%. So that's overall supportive of equities. And as it relates to kind of moving into the last quarter of the year, some kind of key things that we're following, the Fed did start cutting rates in September for the first time this year. Solid growth, just under 4% as of the last read. And again, the earnings strength with a focus on technology kind of justify what are elevated valuations on stocks today. So the Fed has begun a cutting cycle, and what this looks at is what rates are expected to do. We're expected to get 2 more cuts this year and continue into 2026. And you've got strong growth at just under 4% for the last quarter. So you got the Fed cutting rates and the economy overall growing. Kind of below the fold, we're not really following it a lot because the markets are kind of shrugging it off. But as of October 1st, the government did shut down. So that is just something to keep an eye on and how long that lasts. But if you look at other shutdowns in history overall, you don't see markets having much of an impact or being impacted much by a shutdown, and that's been the case thus far. Average during a shutdown, slightly positive 3 months after, and then 1 year after. As it relates to the Fed, again, this is where the Fed has been over the last 3 years. The Fed cut rates 3 times in 2024 for a total of 100 basis points. And as of September, the Fed cut rates for the first time in 2025 by 25 basis points, or 0.25%. And again, the markets are expecting at least 2 more cuts this year. And the way to think about rate cuts is whether you get a recession with them or not. And what this top graph shows is that if the Fed is cutting rates and you don't get a recession, that is supportive of both stocks and bonds. in a scenario where the Fed's cutting and you do get a recession, slightly negative for stocks and still positive for bonds. Again, the Fed has a dual mandate of price stability and full employment, so we'll unpack both of those. The October jobs report had the dog ate my homework kind of a feel because since the government was shut down, there was no official jobs report in October. So what we go to is a private ADP National Employment Report that showed a contraction in the labor market by 32,000. And most recently in August, the last time we got an official jobs report, up 22,000, but that was much lighter than 75,000 that was expected. So we do see a cooling of the labor market. And interestingly enough, we've spoken about this before, but just last month, the BLS indicated that they missed by a 911,000 job annual count between April 24 and March of 2025. So again, the jobs market is showing sign of weakness, and this is a pretty big miss over a 12-month period of time, saying that the employment picture was overstated by almost a million jobs. Again, the most recent reading on quarterly GDP was just under 4%, so that's overall positive. And inflation, which we'll get the next read on Friday the 24th. Again, it's kind of being stubborn here at near 3. Again, it's way down from peak at 9 on an annualized basis, but it's still well above the Fed's 2% target. So one question is the market top heavy? We're going to address that in these few slides and kind of talk about this market compared to the dot-com bubble that burst in the late 90s into the 2000s that this market is being compared to. One of the big differences on the tech bubble side versus kind of this AI tech race today is the tech bubble you see that went from June 96 to March of 2000. The earnings growth were 80% and the stock returns was an almost 6x the earnings growth. And so what that showed is that market prices got way out of proportion to earnings growth. What we see in today's environment is a more muted version of those two numbers. So 73% is the earnings growth, but the stock returns are 94%. So there's still some delta there, but it's not nearly the 6x delta that we saw here during the dot-com bubble that ultimately burst. Also, kind of in addressing is the market top heavy. It's kind of what the U.S. is doing compared to the rest of the world. This is the U.S.'s share of global GDP going back almost 40 years now. And you'll see what was 30% 40 years ago is now 2/3 of global market cap is in the U.S. So the U.S. has just been dominant over the last 40 years as it relates to global market cap. And in fact, we have these 7 companies, also known as the Mag 7, settle in on a market cap value of over 20 trillion now as of earlier this month. And that 20 trillion, which is about 35% of the S&P 500, are more than the combined GDPs of all of these countries. So it's really hard to believe and just stunning how much kind of the top 7 stocks in the S&P 500 is driving the world. But that's where we are. And not surprisingly, the U.S. has outperformed international benchmarks over the last 15 years by an almost 2-to-1 margin. And the last kind of data piece before we close today is just a record amount of money market accounts as the Fed has been increasing interest rates. It's made money markets more attractive. They hit as of September of 2025 over 7 trillion. And what these graphs on the right show is that typically when the Fed starts cutting, it favors after there's been a spike in cash. It favors both stocks and bonds. So overall, this kind of cash hoard, if you will, which is a 133% increase over where we were in 2018. If the Fed starts cutting rates, money market rates will go down. Um, the question is, where does that money go? Does it go to bonds? Does it go to stocks? Does it go to spending that has been delayed? This is something to keep an eye on. So with that, we'll work towards close. None of this is a substitute for contacting us directly about how all of these things impact you. Again, we hope to see many of you next week at our quarterly investment forum, where we'll be talking about all of these things in more detail. Again, we also hope to see many of you at our fun curbside tamales and treats event on Saturday, December the 6th. Until we see you again, with that, we'll work to close. If you have any questions, please contact us. We're here to serve you. Until we see you again, be well and take care.